Hi, I'm Assistant Professor Aditi Mathur, International Schools of Business Management, Suresh Kanvia University, Jaipur. And in today's video lecture, we'll be discussing about one of the very important methods to evaluate the project, that is payback period method, which is also known as PBP. So before that, let us just have a quick recap of what is capital budgeting. Capital budgeting decisions are your investment decisions which are related to your long-term assets and are basic of the evaluation of the worth of that investment or not. So you decide that whether to invest in that particular budget or in particular project or not. That decision making is with the help of your capital budgeting. So we have basically many investment evaluation criteria or the methods to calculate whether to invest, accept or not, and they are PBP, which is your payback period method, your ARR, average cost of revenue method, your NPV, that is your net present value, BCR, benefit cost ratio, IRR, internal rate of return, then your DPBP, discounted payback period, ACC, etc. So these are the commonly used methods for the calculation or the analysis of the projects or the investment opportunities. And in today's lecture, we will be discussing on the two of the basic methods, that is PVP and DPBP. Before we begin with the calculation or the understanding of one of the methods, let us just have understanding of few of the important terminologies or the few of the important associate calculations which will be needed in your evaluations of the project or in the different methods. So the first one is, what do we mean by or what is your original investment, which is also known as the initial investment. So your original investment or initial investment is that amount which you are investing or going to expend, right? It is your cash outflow. You are going to put the money out of your pocket. You are going to expend it so that you can have the benefits in future or you can lock that particular project. Same like going and buying a particular product in the market. So the money you pay to buy that product is your cost. Same way, the money which a company or the manager is going to invest or expend so that they can have that project implemented and then earn the return, that money is your original investment or your initial investment or your cash outflows. So these are the three terminologies related with the concept of cash outflows. Then cash outflow, I have explained you the amount, the net amount which you have paid at the 0th year or the first date or before starting of the project, the amount invested, right? That is your cash outflow. Then annual cash inflows. So what do you mean by annual cash inflows? Cash inflow, yani ki cash which is coming in the organization. Inflow. So that cash which is inflow is your profit earned or the money which you are earning from the investment you have made. Let us just take an example and understand the entire concept. So let us just assume that we are going to invest in plan A, right? And the amount which you will be investing is, let's say, 20,000 rupees, right? So this 20,000 rupees which you are going to invest today, right now, is what is your original investment or initial investment or your cash outflow. This is the amount which you are going to pay. Okay, you can even denote it in bracket also because it is the outflow, you are going to pay it. So it can be expressed in the brackets as well. Then comes your returns expected in year one, two, three. So let us just assume you're going to earn 8,000, 9,000, 10,000. So this earnings which you will be doing in the upcoming year or the life of that investment or the tenure of that project, that earning is your incoming cash inflow, and it is known as what? It is your annual cash inflows. Right? So this is what? This is your annual cash inflow, the money which you're going to earn or which you are going to receive after investing in a particular project. And the amount which you have invested in the particular project at the beginning is your cash outflow, initial investment, or the original investment, whatever terminology you want to use. Now comes an important point, that is terminal cash inflow. So let us just assume in this example itself that the project or the plan was only for 3 years. So at the end of the third year, your project will get closed. So earnings which you are going to do in or which you are going to receive in the third year or at the end of the third year, that all amount is your terminal cash inflow. See, the terminologies themselves are very clear and you can understand. Terminal means end, cash inflow. Yani ki at the end of the entire project, the cash inflow in that nth year, at the last year, is what it is. So it is 10,000. So this amount is known as your terminal cash inflow. Right? So the amount which you are earning or you will get or you will receive or it will be an inflow at the end of the project is your terminal cash inflow. Generally, the salvage value of the machinery, that is also a part of your terminal cash inflow. Let's take an example that you were purchasing a new machinery. So that machinery uh, was having a life of 10 years. So at the 10th year, you have decided to sell it, and that salvage value which you have received, that salvage value will be added in your end of the calculation of cash inflow, and then the total amount is your terminal cash inflow. We'll learn all the terminologies and how the calculation goes on, but the basic understanding I'm telling you. Then comes the depreciation. You know the expenditure or the loss or the amount which you calculate, the fictitious amount which you calculate, the non-cash item which you calculate because of the daily use or the normal wear and tear of that particular machinery is your depreciation. It always reduces the value of your fixed asset. Then the scrap value, the amount which you are going to receive when you sell the asset, that is known as your scrap value. Then the timeline, you know the entire timeline, zero and the upcoming 1, 2, 3, 4, the life of that particular project, investment plan, whatever the terminology is in the exam. Now let us just see the timeline to have a clear picture of how our inflows look like in reality. So we have 0th year, one at the end of 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 8 year, 9 year, and 10 year. We are assuming that the project is for 10 year or the investment is for 10 year. So the 0th year represent your cash outflow or the original investment. At the end of 1 year, 2 year, and 10 year till years are your inflows, that is your annual cash inflow. And at the 10th year, see over here, 210 is mentioned. That means this is the annual cash inflow which you are going to receive, and this is the terminal cash inflow. That means the amount which you are extra going to receive at the end of the year, and that might, comprise of your salvage value. You will understand it when you will do the questions, so you will have a clear picture about it. So this is how your timeline looks like. Now let us just learn how to calculate your initial investment or your cash outflow, right? Or your cost or the cash outlay. So for that, you first write the purchase price of the asset. Then you add the insurance amount, frigid amount, your installation cost, right? Then you add the opportunity cost if they're in the question, and you even add the increase in working capital. You subtract the cash inflows in form of scrap or the salvage value of the old assets, and you less the decrease in working capital, right? So this is the flow, or this is the formula to calculate the total or the net investment or the net initial investment amount. So you take the purchase price, add the insurance expenses, other costs like your opportunity cost, increase in working capital if there, so you add that value, and you decrease the salvage value if you are selling any old asset, right? And the if there is a decrease in working capital, then you subtract it instead of adding it up, and then sum that total that up, and that it will be equal to your initial investment or your cash outflow, right? This is how you calculate your initial investment or cash outflow. Now, let us just learn how to calculate your net annual cash inflows. So, for the net annual cash inflows or the operating cash flows, you take sales, you minus all the expenses, you even subtract the depreciation, you subtract the tax, and then you add back the depreciation. After subtracting the tax, you add back the depreciation. 2 points. Point number one, you first deduct depreciation. Point number two, then you deduct your tax. Point number three, you add your depreciation. Now, why you do so? There are basically two reasons. Number one, the Income Tax Act allow you to deduct the depreciation value, right? It is a allowed expense in your income tax. That is why you first deduct the depreciation. That is why it is first deducted before the tax. Why you add back? The second reason to add back, or the first reason to add back your depreciation, is that it is a non-cash item or a non-cash expenses, right? There is no outflow of cash. And remember, we are talking about cash flows, right? So that is why we add back the depreciation, because it is a non-cash item, right? So in another word, if we see your annual cash inflows, it is equals to earning before tax minus minus tax plus your depreciation. You add back the depreciation amount because it is a non-cash expense, right? It is a very important point for you to understand it, because in questions many a time they gives you the puzzled questions, right? They give you the EBT, they give you tax, and they give you depreciation. So you have to first calculate your cash inflows and then put it into the formulas or the method of calculations, right? Now, let us just have a quick discussion on your terminal cash flows. So, these are the cash inflows for the last or the terminal year of the project, includes the estimated salvage or the scrap value of the project, and the working capital, if any, realized. If any, the realization of the working capital is there, which was blocked at the beginning of the project or during the life of the project, that amount is also taken into the consideration, right? Now, let us just have a quick discussion and understanding of your first method, one of the very easiest method, that is your payback period method, which is also known as your PBP method. So this method is also popularly known as your payoff, payout, and it gives the number of years in which the total investment in a particular capital expenditure pay back itself. You have heard many a time that people say is that if I invest in this project, after 5 years I will get back my initial investment, and then after that the entire life I'm going to earn the profits and profits. So that 5-year calculation is what is your payback period method. That after how many years you're going to get back your initial investment, right? You are going to earn back all the initial investment, and then later on the entire life the project will give you just profits and profits. Generally, when you start a new business or you invest in a particular new avenue, you talk like that, that today if I invest 5 crore, how many years back you were going to give me 5 crores? So how many years will take back to earn me that initial investment which I'm putting up today? That is payback period. This period method is based on the principle that every capital expenditure pays itself back over number of years. So they says that whatever you are investing today, the principal amount will pay you back after a certain number of years. It means that it generates income within a certain period. When the total earning or the cash inflows from the investments equal to the total outlay, that year is your payback year. That means when your total net cash flow earnings, right? You cumulate them up. That earning is equal to that total investment in that particular year. That particular year is your payback period. How we will do this? This line or this formula will be more clear when we will do the calculation, right? So just hold on for a minute. We will understand how to calculate that year. An investment project is adopted so long as it pays for itself within a specified period of time, say 5 years or less. The standard of recoupment period is settled by the management taking into account a number of considerations. While there is a comparison between two or more projects, the lesser the number of payback period, the project will be accepted. Definitely, you want to get back your money as fast as you can so that your profit earning years can increase, right? We all know that the lives of the projects or the investment are somewhere down the line, computable. They are standard, right? You will do the investment for 5 years, 10 years, 20 years, so you know the number of years. So we like to earn back that initial investment as fast as you can so that you can increase the number of your earning period, the profit period. So let's take an example that the total investment is for 10 years, right? So you will like to earn your money before the 10 years, that to as fast as possible, let's say in 3 years, so that the remaining 7 years are your profit area. So the lesser the payback period, the profitable project it is. This is how we accept or reject the project in payback period. You will get it one by one when we will solve the question. But you should remember how to accept or reject the project. It is based on the number of year. The project which have the least year, that should be accepted, right? Because the remaining time is all your profit area. It is your party time. You can all have the profits and profit because your cost is recovered. And the fast you recover the cost, the entire life is your profit life of that particular project. The formula for the payback period calculation is simple. First of all, net cash inflow is determined. So first and the foremost thing is to calculate net cash inflows. And we know how to calculate the net cash inflows, right? We know that is PBT minus tax plus depreciation, right? This is how you calculate your annual cash inflows. And you need to first calculate the net annual cash inflows. Then we divide the initial cost or your original investment by the annual cash inflows, and the result question is the payback period. So this is how your formula looks like. Original investment or the initial investment divided by annual cash inflows. This is the formula of your annual cash inflows. If the annual cash inflows are uneven, then how we do it, and if the annual cash inflows are even, how we do it, let us just discuss them one by one. So your payback period is calculated in two situations. Number one, when your cash flows are even, that means in year one, two, three, four, you are earning exact amount, let's say 500, right? Same inflows. And when your inflows are uneven, that means in 1, 2, 3, 4, it is like 500, 400, 300, 600. They are uneven, they are not constant or same. So we'll understand how to calculate in both the methods. So let us just first see the formula when we use the cash inflows are in equal or they are even, right? So what we do, cash outflow or the original investment divided by annual cash inflows, directly annual cash inflows, and then you get the number of years. So let us just see one question. A project cost 1 lakh and it yields an annual cash inflow of 20,000 for 8 years. See, it is a case of even cash flow. Calculate payback period. So what is the formula? Our original investment divided by initial cash inflow. So it is your 1 lakh divided by your 20,000, which is giving your 5 years. So your payback period is 5 years. That means by the end of 5 years, you will get back your 1 lakh rupees. And after that, that means for sixth, seventh, eighth, 3 years will be your profit years. You will earn 3 years only profit because you have recovered your cost of 1 lakh by the fifth year. Right? Let us just see one more example. A project costs 5 lakh and it yields annual profit of 80,000 after depreciation at the rate of 12%. But before tax of 50%, compute your payback period. So we know we need to take your annual cash inflow. So first we will calculate your annual cash inflow. How we will do that? We know what is your PBT. That is your 80,000. We know tax is 50% minus tax. That is 50%. So your PAT is your 40,000. Then we will add back the depreciation. Now, how to calculate the depreciation? We know the calculation of depreciation. The formula for depreciation is value of the asset or the amount of the asset into the rate of depreciation. That is 12%. So 5 lakhs 12% is your 60,000. So you add back the 60,000. So your profit before tax, but after profit before depreciation, but after tax, or your cash inflow, annual cash inflow is 1 lakh rupee. So you now you know your annual cash inflow is 1 lakh, your cost of investment is 5 lakh. So your formula of payback period is your OI divided by your annual cash inflow, that is your 5 divided by 1, that is your 5 years. In this question also, your payback period is 5 years, right? So you have to first learn how to calculate your annual cash inflows. It is must, it is the basic necessity of the question itself. So just read the question very carefully, right? Slowly understand what is given in the question, what you need in the formula, and then use the methods to calculate the final answer. Now let us just do the calculation for the third illustration. The management of the Health Supplement Inc. wants to reduce its labor cost by installing a new machinery. So they want to reduce their labor cost. That's why they are coming up with a new machine. Two types of machineries are available in the market: machinery X and Y. Machinery X would cost 18,000, whereas machinery Y would cost 15,000. Both the machineries can reduce the annual cost by the 3,000. So your cost will get reduced by 3,000. Which is the best machinery to purchase according to the payback period method? This is how the questions come. Then decide which one to accept or which one to reject. So we know the formula, that is cost of the machinery divided by net annual cash inflow. So the cost is what? 18,000. And how much it is going to reduce? It is going to reduce your 3,000. So divided by 3,000 because it is your extra income, the annual cash inflow. So it is 6 years. For machine Y, it is coming to be 5 year. Now, which one to accept? Your machinery Y should be accepted because it is least in comparison to your machinery X. Machinery X will take 6 years to get back your investment, but machinery Y is taking only 5 years to get back or earn back your investment. That is why accept machinery Y. You have to always write the decision statements, and that carries marks. So please always in the question write a decision statement. So this is how your decision statement is given or written. According to payback method, machinery Y is more desirable than machinery X because it has shorter payback period than the machinery X. Now, let us just understand and learn how to calculate your PBP when your annual cash inflows are uneven, right? So, it is a big formula. Don't worry, we will just understand it with the help of a question. So, let us just first jump to the question and then we will come to the formula. But if you want to look at the formula, this is the formula that the PBP is equals to base year plus initial investment minus base year cumulative cash inflow. CCI is your cumulative cash inflow whole divided by next year cumulative cash inflow. So now what is your base year? What is your next year? Let us just do it with the help of a question. So this is the question number 4. In the case considering an investment of the company is considering an investment of 1 lakh in a project. So your outflow is 1 lakh. We know that much. Okay. The following are the income forecast after tax and depreciation. First year 10,000, second year 40,000, third year 60,000, fourth year 20,000, fifth year nil. Okay. Now let us just do the calculation. First one, that is payback period. So for the payback period, what you are doing it, you will just calculate it with the help of a table. In these methods, when you have uneven cash inflows, you calculate the cumulative cash inflows, right? So how do you calculate the cumulative cash inflows? First, write down the years and the annual cash inflows, that is 10, 40, 60, 20, and then calculate the cumulative one. So the first year, the cumulative will be 10,000 itself. Second year, it is going to be 10,000 plus 40,000, that is 50,000. Then 50,000 plus 60,000, it is 1 lakh 10. Then 1 lakh 10 plus 20 is 1 lakh 30. In fifth year, you are not yielding anything, 0. So 1 lakh 30 plus 0 will give you 1 lakh 30,000. So you have calculated your cumulative cash inflows. In economics, in your stats class, when you do the frequency question, the way you calculate your cumulative frequency, the same way you have to calculate your cumulative cash inflow, right? 10,000 plus 40,000, 50,000, then plus 60,000, 110 plus 20, 130 plus 0, 130. The same zigzag, right? Now, I do hope now you got the recall that how you used to calculate your cumulative frequency. The same way you are doing your cumulative cash inflows. Now, what you do is, you then identify the year by which you will be recovering or you will be covering up your initial cost, that is your 1 lakh. So if you see this question, you can see that third year you are going to recover the cost. See, 1 lakh 10 cumulative cash inflow. You will always check the cumulative cash inflow. I'm writing it over here. Check cumulative cash inflow, that in which year you will approximately going to cover up your initial investment. So it is the third year in which you are going to cover up your initial investment, because it is coming 1 lakh 10,000, right? And our investment is of 1 lakh. So now let us just put the figures. So this is your base year, right? Your base year is 2, because sorry, your base year is second year, right? Why it is second year? Because in the next year you are going to cover this 2 years, 2 and 3. In between this 2 and 3, you are going to cover your somewhere around the 1 lakh rupees. So base year is 2. So base year plus initial investment, that was 1 lakh, minus cumulative cash inflow of base year. So cumulative cash inflow of base year is 50,000 divided by cumulative cash inflow of your next year, that is 60,000. Cumulative cash inflow of next year. Let me just write the formula. PBP is equals to base year plus initial investment minus cumulative cash inflow of base year divided by cash inflow of next year, right? Cash inflow of next year. Remember this. This is the correct formula, right? So that is why it is 2 plus 1 lakh minus 50,000 divided by 60,000, which will give you approximately 2.833 years. That means in 2.833 years, you are going to get back your entire money. That is your 1 lakh, right? So this is how we do the calculation when your inflows are uneven. So you calculate it with the help of your cumulative cash inflow. Remember the formula and you can easily do it. Now let us just have a quick recap or understanding of your cash flows, how you do it in the PBP. So when it is even, you just have your outflow divided by inflow. But when it is uneven, you take the help of your chart. This is not cumulative beta. It's a misprint. Please ignore it, right? Please ignore it. It is next year cash inflow. So CI is your cash inflow, right? So this is how you calculate it when it is uneven. Now let us just discuss how do we calculate the discounted payback period. Now this word discounted might be very, remembering you something. So this word discounting is from your time value of money, right? So from that time value of money, this concept has been taken up, the discounting concept. The rate are taken into the consideration to calculate the present value. So the discounted payback period is the next level of your payback period where the cash flows are discounted before calculating the present value of payback, right? So over here, now we are taking into the consideration the time value of money concept. Till now, we were ignoring this concept. But now we will continue with the time value of money calculation. It is an advanced version, the next level, more refined method, right? Some companies prefer to calculate the payback period as it is considered the time value of money. So you use this method more oftenly because it gives you the realistic data, right? So how you do it, let us just have a look at the same question. In this question itself, the part B is discounted payback period at the rate 10% interest factor. So they have given you your PVIF factor, that is your 10%. So how you do it, you simply calculate your, first you write your years, then your cash inflows, then your discounted present value at the rate 10%. How you calculate it, I'll tell you in the calculator. Just take your calculator, right? It is all clear. So now what you have to do it, you need to calculate the discounted present value. How you do it? The formula is 1 divided by 1 plus r to the power of n. So what is r? 10%. So it is 1 divided by 1.10 to the power of n. How you do it in these types of questions? The calculator, it is here. So what you do it, you type, you press 1, then divided by 1.1 equal to, right? So your figure is coming, you can see it on my screen. I'm trying to show you. So your figure is coming approximately 0.9091. Take it to the power of 3 or power of 4. It is up to you, but you can round it up. So this is 1 divided by 1.10 to the power of 1. Now to the power of 2, how you are going to do it? Simply equal to sign. See, it is 0.8265. If you can see, I'm trying to show you on the calculators. See, 0.8265. For the third year, just again press the equal to button. Fourth year equal to button. Fifth year equal to button. And this is how you get your present value in the calculators, right? So you just write down all the present value factors, discounted present value factors at the rate 10%. Then you multiply the inflows with the discount factors so that you can get your present value. So you multiply 2 into 3 to get your 4. And then you cumulate this one beta. Now you will do the accumulation for this one. You will take into the consideration this. So it is going to be 9091 plus 33060. Then it is going to be plus 45078 plus 13660 plus 0, and it will be 100889. So again over here in this question, your year is 3 and 4. In between year 3 and 4, you are going to get back your entire 1 lakh. So your base year is third year. So base year plus initial investment minus present value of cumulative cash inflow of your base year divided by present value of cash inflow of next year, है ना? Be very clear. ऊपर cumulative है, नीचे only cash है, cash inflow है. So it is 3 plus 1 lakh minus 87,229 divided by 1, divided by 13660, right? And it will be 3.935 years. So at the end of 3.935, you will get back your 1 lakh rupees exact, right? So this is how you do your discounted payback period calculation. The only difference is that in discounted payback period method, you take into the consideration the time value concept, because the fact is that you are going to earn this money in future, and you are calculating the money without taking care of the time value factors. It is like you are doing a big crime. So that is why it is an advanced version, a refined version of normal payback period. The only difference is that first you calculate the present value of all the inflows and then do the rest of the calculation. So your cumulative will be taken care by your present value in your DPBP method. So now let us just have a quick recap of what we have studied today. So today you have studied lots and lots of new concepts, but it was very important for you all to do it. So we have discussed few of the techniques. Then in detail, we understood the timeline, computation of initial investment, computation of your cash inflow, your terminal cash inflow, your payback period method was discussed in detail, in which you discussed both when the cash flows are even and cash flows are not even. When the even formula is simply outflow divided by annual inflow, but when you have uneven, then you take the help of the cumulative chart. Then we had a discussion and we learned the concept of the discounted payback period with the help of the question as well. So now let us just have the quick revision test with the help of the MCQ questions. So I have a set of 10 MCQ questions, and let's see how many of you score 10 on 10 with the help of the video lecture which we have gone through today. So all the best to everyone, and the first two questions are on your screen. Question number 3 and question number 4. Question number 5 and question number 6. Question number 7 and question number 8. And the last two MCQ questions, question number 9 and question number 10. So let us just have the discussion on the correct answers. The correct answer for question number 1 and question number 2 is option B. Question number 3 is option B. For question number 4 also the correct option is option B. Question number 5, the correct option is option C. Question number 6, the correct option is option A. And for rest of the question, that is question number 7, 8, 9, and 10, the correct option is option B. So I do hope that you all have scored 10 on 10 and understood the concept of your PBP calculation and DPBP calculation and the associated small calculations like your initial investment, annual cash inflow, terminal cash inflows, timeline, etc. So thank you everyone for watching this video lecture. Have a happy learning.